Good morning and welcome back to Almus Market Mornings. It is somewhat of a positive day for a change. Generally, Asian equities seem to show a positive risk appetite at the start of the day, while the US market showed some recovery last night. State of the Union address by President Trump has already started. It is being closely watched for any major policy indication, especially on the tariff side. And moving on to actual economic data, Australia's inflation came in stronger than expected in January at 3.4%, above the bank's target for the seventh straight month. This has led to markets pricing in a second rate hike by the RBA. And let's talk about yuan, where it seems the PBOC has set the yuan fixing at the strongest level in 33 months against the dollar. Uh, Good morning, JK. What are your thoughts on these key developments?
Good morning, Swaraj. Not much of economic data to focus on. We only had the consumer confidence number in US yesterday, and that increased actually by 2.2 points in February. That was one positive, data point. Other than that, we did not have much. The expectation index based on consumer short-term outlook for income, business, and labor market conditions also rose. Consumers were, generally, somewhat pessimistic. Comments about prices, inflation, and cost of goods remained at the top of their minds as well. Also, the labor market conditions, the concerns eased a bit in February. Yes, as I said, Australian inflation number came higher, and the Australian dollar has gained a bit based on that because there is an expectation that Australian central bank will hike rate. Now, overall, global markets is now more and more directed towards the AI-related assessments or developments. For instance, while earnings report for Q4 have not been bad, the US stocks have tended to weaken in a two-step down, one-step back up fashion. And technically, they are looking more vulnerable. Market is also digesting tariff-related uncertainty and the conundrum of US monetary policy, where various Fed members remain divided on their views. But balance has definitely shifted towards keeping the rates current level for longer. Those calling for cuts or in a minority, and those for a rise are even lower minority. But this is all translating into a bond market that is directionless, with yields stuck in a 10 BP range for quite a number of days now. Really, markets are looking for something of a larger trigger to get bigger direction. But it's good to see that stock markets have not crumbled based on various negatives. In fact, the market falls are confined to only select regions like US, where valuation concerns are high and the AI-related concerns are also at the peak. And in India, of course, the valuation concerns continue to plague the shares. In other regions like Japan or Europe or even South Korea and all, I think the markets are still doing very well. They've been steadily gaining based on again valuations which are more attractive. In the meantime, what's happening to the dollar? The greenback is also missing a unified direction with divergent short-term trends seen. Euro remains somewhat pressured despite steady to strong economic data because the market positioning is super long. GBP is holding up due to relatively higher yields, but dovish developments, is potentially negative for pound. Yesterday's statements by Bailey, the Bank of England chief, was quite mixed, but he was favoring a rate cut, but not sure that it will happen in the near meeting. Yen remains, of course, very vulnerable to what seems to be a politically influenced monetary policy, and we definitely wait for more clues on the next move on rates as the currency is moving into a zone of intervention. There was, a day after the report indicated that Takaichi, the PM, had conveyed a reservations about further interest rate hikes to Bank of Japan and said there are pluses and minuses to the weak currency. Actually, today she made a statement closely watching FX moves with a high sense of urgency. So the yen is now actually in a state where it could be more prone to some strength But I think so as long as the risk sentiment is positive, markets will not be buying yen, which is still carrying low yield, of course. As far as the rupee is concerned, it's been kept on a weaker end of the range due to persistent demand and supply coming only from one source, that's the RBI. It's also on market reports of huge NDF short maturities in the coming days that needs to be covered. So far, 91 has held, but any break there could open floodgates for another step up in USD INR, which has so far not reacted much to the DXY up move as well. And finally, the Chinese yuan today, another fixing lower for the USD, well into the 33-month low for the USD, and CNH has reacted by trading below 6.88. Although the market, technically looks a bit oversold on the Chinese, US dollar against Chinese yuan, it's not, really showing that jump, and with the central bank also aligned with some strength in the currency. I think we may be more into a time consolidation rather a price consolidation, and await the broader direction from the dollar index. Thank you.
Thank you, JK. And yeah, currencies broadly, it remains in a range, whether it is DXY or Euro, Pound holding up quite well. Yen remains quite vulnerable to a politically influenced monetary policy. That's something to watch out for. Rupee has been kept on the weaker end of the range. Something to watch out for would be the NDF short forward maturities, as it is keeping the dollar demand on the higher side. And any sort of recovery in the dollar index might make the rupee further vulnerable. Equities, even though they seem to recover, they are doing well only in small pockets. Asian markets are generally doing well, except for India. And in US, of course, the valuation concerns are sort of causing this sell-off. Bond markets otherwise remain in the ranges as well. That's it from us today. Thanks for listening. We will catch up tomorrow with a fresh round of updates.